This video explains in full the 8 steps to invest and trade in exactly the same way institutions do. At the end of this video, I will tell you how I can help you with these steps as well. My name is Hassan Afifi. I have been investing and trading for over 25 years, and I have worked as an equities advisor to some of the largest institutional investors in the world. What I'm going to show you here is the proper way these institutions use in order to get these consistent gains over years. One of the main factors behind the failure of a lot of individual traders and investors is that they follow certain ideas without thinking about them themselves. I shall explain to you how anyone can easily approach investments and trading in a way to make them profit consistently. These methods have been used by institutions over decades, and they do not get old, and they are timeless. So if you're serious about making consistent gains from investment and trading, stick with me for the next few minutes and I will show you how you can make the right start. Please note that some of what I'll be talking about is stuff that you will definitely not hear anywhere else, because some of it is either not known by retail traders or they're just perceived as too complex. But I'll make it very easy for you to follow and understand. I'll start off by explaining the theory, and then we'll share some actual real-life examples to clarify them. The first concept you need to understand is the top-down approach. By top-down, we mean looking at the big picture first before making the decisions about individual investments or trades. So the first step needs to always be related to how you look at the world and your own expectations of the economic and political scene. This is what we call the macro view. Now, you may ask, how does this affect our own investment and trading? Well, we can look at events of 2020 as a good example to see how this works. Due to the world locking down, think about which industries lost the most and which ones gained. For example, airlines and cruises would have been a very bad investment decision because these were two sectors that were greatly affected by the world locking down. On the other hand, companies that were offering services like online meetings saw great success this year. Another example would have been the flow of money out of oil companies into green energy providers on the back of political results in the US. Themes like these are super important to note before even thinking about the next steps, because they lay the foundation to everything we're going to be doing. But this is for equities or stocks. What about commodities and forex? Well, the same goes for both. If we think about commodities in 2020 when the world shut down, there was no longer any demand for oil, and that meant there was a huge oversupply, sending oil prices crashing down. On the opposite side, people who were still getting financial support from their governments wanted to put their money in safer investments. So they bought gold, sending gold prices to all-time highs. In Forex, currencies are also affected by economic and political events. We saw how the sterling pound moved every time there were news about Brexit. Or with some currencies which are linked to commodities, like the Swiss francs and gold, movement in the currency can be related to movement in the commodity price. So as you can see, it is always really important to know what's going on from a macro view in order to make the right decisions about your investments or trades. The second step after deciding on your macro view is to decide on which themes are going to be the strongest. If we continue from the examples we've discussed earlier, we could look at the two themes of airlines and online services as the two opposite ends of the spectrum. If we were making our decision back in April 2020, when we didn't know how long we would be indoors for, we could have easily said that we didn't want to do anything with airlines and wanted to focus on companies that provided online meetings. And this was exactly what happened in the markets. Institutions were very quick to transfer their money between these two industries. There were some other themes that weren't as convincing or as strong, and trading these themes was not as dramatic. An example of this is how markets reacted to prices of commodities like corn, wheat, or even silver. People didn't know how these commodities would be affected by the political and economic events, and trading them was just not as clear as other themes. So find the themes that you are convinced with and that you see have strong foundations. The third step is going to be how long you think the theme is going to last. For investments, you want themes that you see will last a year or two. Or for longer term investments, you'll even want themes that you believe may last for decades. As for trading, you'll be looking for themes that have quick and sharp effect on the markets in the short term. The duration of the theme is going to be one of the strongest keys to unlocking profitability for your investment or trade over the period that you're expecting it to last. The fourth step will be creating a short list of the instruments that you will want to invest or trade. When you've decided on the theme and the duration of the theme, you then need to look inside the theme to see what companies, commodities, or currencies that relate to your conclusions are best placed to benefit or lose out from this. Notice that we haven't even started talking about prices, valuations, or charts yet. These are coming up, but they can only be talked about after laying the proper foundation first. This initial bit of research that goes into creating that short list will open your eyes to new ideas and make you understand more about the sectors that you're looking at, which always comes in handy if the markets start to act irrationally. In step 5, we'll start to look at prices and valuations. For investments, valuation is the most important factor that you'll be looking at. The valuation can also be found on websites as the target value or the fair value, which is the share price that analysts have reached after valuing the company. This is reached by analyzing the company's fundamentals, looking at the industry it's in, its operations, management, future prospects, etc. When you invest in a company, you're then a shareholder, and you should care about it as your own company. After all, you own part of that company. So on your short list, you need to write down the target price for each of the companies, and then look at which ones are actually undervalued so that you can make up your mind about which ones to invest in. For trading, the story is quite different. You're looking at price movements over time rather than fundamental price targets. Prices do not always move due to fundamental factors, but they always move with market sentiment and speculation. A good example of this is the recent panic that happened when Facebook faced litigation in the US calling for its breakdown. We saw all tech company stocks fall regardless of what these companies actually do or whether they might actually be facing similar lawsuits. The sell-off was due to market sentiment just not wanting to do anything to do with tech, but ignoring the company's growth, operations, profitability, or any other such factors. Traders have to be aware of these price movements and what caused them, while investors don't always care about such moves, because they make their money by being shareholders in a company, while traders make their money buying and selling the shares. Investors could also see such fall in price as a good opportunity to buy the shares, especially in companies on their short list that seemed expensive before and now the price might justify the investment. Following price movements in trading is done through technical analysis. With technical analysis, traders look at charts and use indicators to look at historical patterns to try and predict future price behavior. And I believe this is where the main difference between retail traders and institutions comes into play. Most retail traders would look at the charts and indicators, follow some theories, without much knowledge of the dynamics of where the movements came from. Institutions, on the other hand, would always have to look for catalysts before taking the trade. This is step 6 in the process, and it is about finding the catalysts. If there is one lesson every trader should learn, is that they should never ever take a trade without having a catalyst in place. Even if the catalyst is speculative, it has to be present. For example, a company releasing their earnings in a week can be the catalyst needed for the price to move. If you expect the company's results to be better than what the market thinks, then you would be expecting the price to go up, and that might affect your trade decision. We saw this clearly in the run-up to the US presidential elections, where certain prices of companies or sectors moved every time there were news about who was in the lead, or every time we heard any results of polls. The same goes for investments, but with a slightly different outlook. Investment catalysts could be factors that may take years to develop. Some recent examples of this could be software development for self-driving vehicles or space exploration. These are two examples of catalysts that may take years to develop. But one could argue that these could be game changers for companies involved in developing them. Others could, for example, argue that oil may be dying as a source of energy. So they would stay away from energy companies relying on oil, but could shift their focus on companies involved more with green energy. Catalysts always have to be present in your decision to invest or trade. Steps 7 and 8 are mostly for traders, but investors can use them as well. Step 7 is about choosing the time frame. One of the main questions traders tend to ask is which time frame to use. Remember step 3, you've decided on the expected period your theme will last for. Combine this with the catalysts identified in step 6, how long you think they'll go on for, and how far away in the future they are, and you can decide on your chart time frame. A catalyst that may be happening during the day means that you'll probably be looking at very short time frames for intraday trading. 5 minutes, 15 minutes, or an hour are the usual time frames used for this. A catalyst that is happening at the end of the month may make you move to the 4-hour time frame, since your trade is more likely to last for a few days or even a couple of weeks. As for investments, you'll probably want to look at the daily or the weekly time frames, which should give a better idea of what to expect over the long period of time you're going to be holding your investment for. Step 8 is the choice of indicators. There are so many indicators that technical analysts use, and these can differ from one instrument to another and from one time frame to another. But there are some indicators that I always use as a starting point. First, I have a few moving averages on my chart, RSI, MACD, and the Lux Algo indicator, all of which could give a very good view of where things might be going. You can check the website to see how we use these. I'm not going to go through details of analysis here, but I just wanted to say that there are certain places to start, and that the analysis for one instrument can be completely different from another. You need to do your own research into which indicators to use, since the ultimate decision is yours. If you do not follow these 8 steps for each and every trade or investment you're going into, you should expect to eventually have massive failures to wipe out any previous gains you might have had in the past. While these steps are simple, I realize that they might not be easy to complete by everyone. And this is why there are those who last longer than others. My job for many years has been doing the research part for institutions, looking at the macro picture and market dynamics, and giving my opinion on these. I have basically been doing the first 6 steps for them, and they only had to take the last 2 steps to decide on entries and exits for their trades and investments. I have developed the exact same market commentary to suit retail investors and traders, providing the highlights of the first 6 steps. Analyzing the macro picture and interpreting market dynamics takes years of experience and education in order to turn them into something meaningful. What we do at RSV Markets is that we provide this market commentary to be easily used by everyone. For investors and swing traders, we have our monthly and weekly reports. For traders, we have the weekly and twice daily reports that provide the market commentary necessary to shape a view of the markets. These reports are organized in a way to be easily understood by anyone and also make it easy to find what they're looking for. The first page starts with a general macro view and the important factors that may move the markets. This is then followed by commentary on each asset class, broken down into indices, stocks, commodities, and forex, suiting everyone's taste. The final part of the commentary is our general approach and any other relevant information. After the commentary, we include some charts with the best technical setups we could find. These are there to give general ideas to those who are interested in prices of certain instruments. We then have calendars, which include earnings releases of the day or the week's earnings in the weekly preview. The ex-dividend calendar is a useful resource for both investors and traders, albeit for different reasons. Investors might want to know when they're entitled to receive a dividend and when to expect it in their account, while traders should be aware of price adjustments after ex-dividend date. The economic calendar is a rather important resource for those who trade indices, commodities, or forex, since these tend to move according to economic data. We also highlight the factors that might have the most impact on the markets to make it easier for everyone to find. Each of the calendars includes what analysts are expecting, so that when the actual figures come out, it is easy to tell immediately how these figures can affect sentiment. Finally, in our daily report, we include analyst upgrades and downgrades of companies. These can be important for investors and traders, as these broker upgrades and downgrades can be the reason for price movement, as well as giving investors a quick reference to themes they might be already following. We go through a process of constantly following all news sources and market movements in order to draw a picture of how events may be affecting investments or trading sentiment. We then put these in our reports twice a day, once a week, and once a month. We also do our technical analysis and put the best charts in the reports so they can be starting points every day for some ideas. We then update the calendars and analyst research to provide up-to-date information. Just go to our website and check it out. If you decide that this is not for you, just walk away and continue as normal. If you decide that these reports are helping you out, you can subscribe for a membership to keep receiving them and continue to invest and trade properly. Click on the link with this video to go and check out how we can help you make the first 6 steps super easy for you. See what you've been missing and start to invest and trade like a pro. And get that advantage that you've always wanted. We wish you all the success in your investments and trading, and we hope we can be of help.